We have a big week ahead in the markets. Excited to be back with everyone today. We're going to be diving into all the economic reports coming out. A little bit of everything. We got GDP, we got jobs, we got inflation. What more could you ask for? We're going to be discussing all of that and more today on Money Never Sleeps. Welcome back to Money Never Sleeps, everybody. Before we get going, do us a favor. Hit that like button. Subscribe to our channel. Nothing that Kevin or I say is financial advice. We're not financial advisors. We're a few guys who love following the market. So please do your own research before making any buys or sells. Shout out to our guy, Mr. House, for stepping in and taking my job for a couple days. It felt like I might be getting replaced permanently because he did such an awesome job there. Appreciate you, my man. Kev, we are 1 hour away from the close of the traditional finance markets today. Things are, on the green side in TradFi and still just on the boring crab walking sideways side of things in crypto. What has your attention as we start this week?
It's absolutely insane how busy this week is and how much is on my plate right now in terms of things I'm keeping an eye on, right? Obviously, crypto's boring as shit. But if we're looking at everything that's lining up this week, we got the traditional financials, which is going to be a huge monthly close. And luckily, the monthly close comes on Thursday, which is also when we get that PCE data, correct? So it's like everything's just kind of lining up perfectly for there to be, a little bit of a push into it. And then let's see how the markets react. So I'm keeping an eye on TradFi this week. I'm also keeping an eye on what's going on in China. Tons of stuff out over there. They cut trading fees in half by 50%. So it was up to 5% early in the day, went down to 1%.
Yeah, it came back. No one wants to buy anything in China right now. Like we've talked about, it doesn't matter what market we're in. It is a sell the news event when anything, if it's good, if it sounds good, the markets are going to use it as an opportunity to sell off and get money off the table right there. So real quick, let's go into what is coming this week. You've been saying for a while that you believe that September and October could be ugly. The reports that we have coming out this week is going to determine a lot of that direction, I think. So nothing came out today. Tomorrow, we get the JOLTS number, which is going to be the number of job openings, as well as some consumer confidence. So just kind of like it's like the amuse-bouche of the week, if you will. It's like a multi-course meal here. Wednesday, we get some private sector employment numbers. So the ADP number comes out. We also get the revision to Q2 GDP. Interested to see what that is. That's kind of like our appetizer for the week. Thursday is going to be the main course. We're going to get personal income, personal spending, PCE, core PCE. That's going to be great. And then Friday is the dessert. We get that August jobs data. So it is set up perfectly for a very volatile week in the market. We saw one Fed member last week say something to the regards of thinking that there could be another 25 basis point hike in September. Since that time, we've seen the target rate probability move. It is now at 78.5% chance of no hike, 21.5% chance of 25 basis points. You may think, well, that's not a big deal. Still 4-1 chance. Wasn't too long ago that it was at 90-10. And if we see data this week that suggests that core inflation is still running high, if we get a number on Thursday with core PCE showing that it hasn't really budged, don't think that the Fed won't put that back on the table, okay? It is absolutely there. Add in the jobs data with all of that too, looking at Q2 GDP. It's just set up to be, the last couple of weeks we didn't have a whole lot of data coming out, but we still, we have some good shows there. But I'm really excited for this week, man. There's going to be a lot happening. Working overtime there. I cannot wait.
Yeah, no, it's going to be action packed. I think that we are kind of in this place where for the rest of the year, we have, it seems like everything's just lining up perfectly going into Q3 to start Q4, right? We're getting some data, and this data is going to be really dependent on how the market reacts. I think the markets, for the most part, have been pretty optimistic regardless of whatever the data comes out and Powell says. They think that we are going to see a bit of a pause, and it seems like there's a chance that we are going to pause fairly soon, right? Not saying next meeting or the meeting after, but it seems like Powell is ready to keep rates elevated and just sit and assess and see how this plays out based off his speech on Friday. But he also said that, they're still data dependent. If they get some bad readings, the rates are going to definitely increase. I still think we're going to get at least one more rate hike this year, if not, depending on how the data comes, post this at the end of this month. So I think that we are still in an extremely dangerous place for rates staying elevated for a period of time. And if the markets are buying into this data, maybe they sell off once they get the data, and that's confirmation that okay, there's a good chance that rates are probably going to go up, or they're going to stay elevated for the remainder of the foreseeable future.
Yeah, we're now seeing as well the probability for 25 basis points in November is up. It's over 50% now. So the markets are pricing in that we're going to get another hike at some point this year. Will we start to see that move more towards September? Remains to be seen. It's going to be a lot of, once again, and we'll see how truly data dependent the Fed really is, but it's weird out there, man. You have all of the concern around the housing markets and commercial real estate, and we're going to talk about banking in a little bit. Before we get to that, why don't we just kind of briefly touch on crypto? Because, like I said, not a whole lot happening, man. We're stuck in this range. The monthly close could start to shuffle things around a bit based off of where we are. But why don't you kind of give us the rundown of what you're looking at in crypto right now? Because to me, it's like I didn't go anywhere because the numbers are exactly the same as when I left the last time I did a show with you on Wednesday.
It's pretty much been like that, man. You have not missed much at all. I think Bitcoin has been so boring, but that also scares me a little bit just because even though this is a continuation pattern, you never underestimate anything that happens in crypto. We know that there are market makers. This is unregulated, sector of finance. And we saw today that, $100 million worth of TUSD was minted and sent to Binance Hot Wallet. That has many implications, but again, we probably know who that was. But you always want to be careful of that because, a little fake pump there could definitely, liquidate a lot of positions. And we want to make sure that we're safe, protected, and we know the direction of the market. So in a sensible market, this should be going to the downside, right? Again, that would be anticipating that we have a 5-wave move, wave 3. This is somewhere wave 4, wave 5. We have to understand that wave 4 can still go, as high as below wave 1. So that's around 28K. I mean, it's very possible it could go up there. However, with the price action that we're seeing, and every time that it drops below 25.9, I would say that we are seeing more defensive positioning as opposed to offensive positioning. I think a lot of people are in some way just trying to keep the price up. They're not necessarily trying to buy more to push the price up. I think they're just trying to buy time at this period. And that's just my assessment from what I've seen. We talked a little bbit about that on Friday, but this is just taking a look at this. We've been trading for the past few days this little bear pennant, right? This is hitting our ass head. We hit our head earlier today, and it looks like we're there on the daily. We still got a few more days before we see any price movement. It looks like this should end come the 31st or the 1st of September. So that tells me that, okay, it's going to come down to the monthly close once again. Seems like everything's just lining up for the monthly close this year or this month, and it makes sense, right? It's just the way that trading goes. But I do want to look at the monthly close ahead of where we are right now. So if we can close this monthly close below 2,500, 280, that tells me that we're going to see bearish continuation, right? Obviously, we're going to keep pushing down. I think that wave 5 of where we go from here is probably going to be somewhere around this green line, which is 23,629, which is in line with the 50 moving average of Bitcoin on the monthly. I think that's very possible that we could hit that. I'm not saying that it's going to drop, that'd be a 10% drop in the next 2 days, but I do think that we are going to be seeing ourselves maybe head towards that area. I think the monthly close is going to be a little bit more resistant than we probably anticipate. And, in terms of support being, fairly strong. So we'll have to keep an eye on that. But if we look on the weekly, right, this is going to be really important too. We are continuing to close below the 50 moving average on the weekly here. So it's likely that we're going to have to test the 200 fairly soon. But the thing that's getting in our way is this resistance right here on the weekly at 25,284. That's been, level of support back here, support here, support currently. It's been resistance back here. But if we can break through that, it's a good chance that we're going to test this, this 200 EMA. And again, the more that we stay below this 50 EMA, it's going to start following. And if we start closing below the 200 EMA, then that's very bearish. And we're going to start seeing that 50 cross and probably get closer to that 200, right? So that's what I'm seeing with Bitcoin. Again, if we look at this on the macro too, on the monthly, the thing we got to keep in mind is that we are outside this blue parallel channel and we're extremely overbought in the monthly and the volumes are extremely low, right? So that tells me that if there is going to be a move, it's likely to be down. I don't think that we're going to get back into this parallel channel. Stranger things have happened, but I don't think with, the price action we've seen, how 31's been extreme resistance and how we're barely pushing up above 26K right now, I think that it's likely that we're going to continue to push down on the monthly. So that's what I'm seeing for Bitcoin. I think in the short term, it is possible that we could go up to maybe we could push up to the 200 or the 50 moving average on the daily. Again, I think we're going to find some really good resistance. There's a lot of resistance in this area. And again, we're also seeing the bottom of this parallel channel that's in this range too. So we got 1, 2, 3, and then probably something around here that's going to act as resistance as well, probably around the 26.8, which we got rejected from back here. A lot of resistance for Bitcoin ahead, but again, never underestimate the possibility of a squeeze or push up that could finish wave 4, and then wave 5 would take us probably closer to this green line down here around 23,629. So that's Bitcoin. I want to talk about ETH because ETH is very interesting to me too. Look at that. I didn't even have to say anything, but you guys know what you see. Yeah, it's a death cross. I give it 2 days. I give it 2 days. That's going to kiss, right? And the problem is, even if the price decides to push up, it would have to push up higher than the 200 EMA to stop this 50 from crossing underneath, right? That's the way it would have to be, and it would have to be fairly soon. Is it possible to get a squeeze? Yeah, sure. Again, I just don't see the money coming in right now, and I'm not trying to stick my foot in my mouth here, and then it happens a week from now or something like that. That's obviously we don't want to see. We want to see this give, right? We want to see this 50 crosses 200 because that gives us continuation, and likely it might push up a little bit in the short term, but that shows you that we are in a bearish state of play right now with Ethereum. The last time we saw this was when ETH was all the way up here in January 2022, and even though this was at the beginning of a bear market, I will say that this is why you were able to see this pump afterwards. Like again, it crossed down here, but the price is all the way down here at that red line. Then it shot up and then it came down, traded as a 3-wave correction, right? And then it continued down there for 5 waves. So even though it did that, I want to look back at 2018 because I think that's going to give us the best metric for when it did cross and what what happens when the 50 crosses the 200 in a bear market. And I think that's going to be what we might see here, right? So this is maybe it was 2019. Oh, no, here it is. No, it's 2020. We don't count that. That's COVID. I think it's back here. Yeah, it's back here. Okay. And this is very similar to what we're seeing now, right? We saw a huge pump up, and this is their, second shot up higher, about, I don't know, maybe I'd say like 20 to 30% of, the height of this move, which is where we would be today if we're looking at the all-time high of the 2021 bull market. And then where we are now, this crossed here back in, let's see, June of 2018. Yeah, 2018. And then it just kept on going down. And this is honestly what I'm anticipating. Once we got the daily cross, you could see how much it went down. It's pretty significant. And I do think that this is probably going to be what we see too. Again, it doesn't have to be, but I think that there isn't a lot of money in circulation right now. I think there is a bit of a crunch, and I again, I'll go into it when we talk about banking, but I don't see a lot of money coming in to push the price up. And if we just look at 2 weeks ago, Evergrande happens, they filed for bankruptcy, and next thing you know, it's like, okay, everything dropped significantly. No one really questioned why it did, but here we are, and it looks like that just pushed us further towards the edge of where this 50 and this 200 will cross. I mean, we could look at the weekly as well. Nothing too crazy here. Other than we're above the 200 EMA, I think that we probably will go below the 200 EMA in the coming months. It just seems likely, right? Again, if this doesn't hold, this 16, we're currently at 1650. If 1627 doesn't hold, then 1619, which is the 200 moving average, is right around there. If that doesn't hold, we're probably going to go down to 1463, and that seems like the next level of key support for ETH on the monthly. Real quick, just because we got to look at it. It's the same scenario, right? If it breaks below this level, it's probably going to test the 50 moving average. If it doesn't hold the 50, it's going to go back down to that level right here, which has been pretty key support in the past. So that's what I'm seeing for ETH. It doesn't seem great. We're going to watch this this 50 and 200 daily death cross probably come in the next 2 days. I'm saying 2 days. It could be 3, but it's within the given range. Likely it's probably going to be closer to the monthly close. But yeah, it's not great, guys. And even if I pull up just total 3 real quick, because this is the total market cap.
That could be if we ever make it to the point where there's like a money never sleeps drinking game. It's not great, guys. That is definitely going to be a Kevin one on the drinking game there.
For sure. It's oh yeah, fucking. You know how many
I
times
mean,
I
if
say
we've
that?
listen, man, if we've reached the point in the bear market where we're drinking at 3 p.m. Eastern, you know that things have gone bad. So just tossing that out there.
Exactly. And then this is just the total. I'm really just trying to give you guys perspective. Again, anything could happen. I really am. I'm cautious because I know how these markets are, and I don't want to speak too soon or get ahead of myself thinking, oh, yeah, it's over, it's over. It's going down forever. There should be a retracement at some point. That's a bit of a bounce, but I don't know if there's enough liquidity for it to be worth someone to put money into this market. And House made a great point of this on the show last week. It's like a game of hot potato. We don't necessarily want to be caught fucking holding this hot potato straight out of the oven, right? And it's going to burn the shit out of you, and it's going to be worthless by the time it cools down. And that's going to be the crypto market, in my opinion. But we can see that the 50 moving average on the monthly is right here at 1.024 trillion. Today we're at 1.033 trillion. Guys, if Bitcoin decides to drop before the monthly close, we're below that. And that just means that we're below the 50 moving average on the monthly. That's huge. And if we look at this on altcoins real quick, I mean, I don't even have to pull up the monthly here. We're below the 50 moving average right now on the monthly. We know that that's not great. Again, there's a drink. Everyone take a shot. And then we have the weekly right here. And here's the 50 and the 200 once again. Keep continuing to close below it. This thing's going to cross, I would say, I don't know, September, October. Again, September, October, it's all about those months. October is one of the worst months in stock market history. September is just usually a really down month. They play hand in hand together. They're brother and sister. But this is absolutely insane. That's another shot. Everyone, I always say this is absolutely insane. But
Yeah.
yeah, that's crypto in a nutshell.
If our buddy Chris here could go ahead and just start keeping track of his favorite Kevinisms, I'll probably have some out there as well, but we'll get that going. Shout out to everybody here so far: House, Randy, Chris, Bundy. Good to see you guys. To Chris's point here, I wanted to take a step back, and then we can get into the banking stuff if that's cool with you, Kev.
Yeah, absolutely.
But the threat of the hike itself, I'm wondering if we're at that point. But I guess where I go back to is the fact like the Fed always telegraphs things, and like they would never threaten a hike without following through on it. I don't think because they don't want to like scare the markets. Yeah. So I don't know. I go back and forth there, but I do agree that the markets could start to, if we hear more Fed speak and we get more of that data, we could absolutely see the markets start to panic ahead of September, and that would be, I mean, we're going to get a fucking death cross there for sure, but let's keep it moving. I know you had spent some time this weekend doing some research into loans and the banking industry. Everyone's acting like it's not that big of a deal and everything's fine. And, Silicon Valley, that was so long ago. There are no other problems. We're going to be okay. We all see the commercial real estate stuff coming. So there's no way it can really hurt anything if we already, know that it's coming. But you were really excited about something, Kev. So I want to give you time to talk about that so we can kind of better understand what you're seeing in the banking industry.
Oh, absolutely. I mean, if I think crypto's fucked, which I do think it is, I think banking is even more fucked in some ways. And we need to keep an eye on that because I don't think the contagion of Silicon Valley, First Republic, Signature, all these things play hand in hand with where we are currently. So I want to pull up something that I didn't really know about until about 2 weeks ago. I saw a video from a guy called John. What's his name? John Titus. He has a YouTube channel called Best Evidence. I'm going to reference a lot of his information on here. This is nothing that I necessarily created or any of this charts, but it's just information I found extremely useful and I think is really, really insightful. So I'm going to pull up my screen, a few things that we're going to take a look at. One of them is federal home loan banks. So it's pretty much, I'm going to read this right here. They're 11 regionally based wholesale suppliers of lendable funds to financial institutions of all sizes and many types. So just for reference in history, this was created after the Great Depression back in 1932. We did see a lot of banks over the history of the U.S. use this as a way to provide liquidity. For the most part, it was for thrifts, which were smaller financial institutions. I mean, not all of them were small. We could take a look at Washington Mutual. That's considered one, and that pretty much would borrow, and it would be. This has become known as the second lender of last resort. So if the lender of last resort is the Federal Reserve, this would be the people you would want to go to second to last, right? So pretty much there's 11 banks within the United States. There's one in Chicago, there's one in St. Louis, a bunch of other ones in New York, and banks can borrow from them, and it's almost guaranteed that they're going to get a loan to provide short-term liquidity. Most of it's between 1 and 3 years, around there. But yeah, they pretty much are approved regardless. It seems like most loans that used to go for mortgage and stuff like that now just go to banks regardless of whatever they need if there's a financial crisis. So that's just one thing you have to keep in mind. And then I'm going to share obviously this nothing too where are we? Why was the there it is. Why it was created. It's created in 1932 by Congress. The mission is to provide reliable liquidity to member institutions to support housing finance and community investment. That's what the goal was, right? But we saw there was a lot of issues that happened with Silicon Valley. And what happened with Silicon Valley is something that's really interesting that goes back with the federal home loan banks and the loans that they were lent out. So I'm going to pull up this chart from John Titus. I got the evidence up here. Best evidence, again, where you can find them. I'll drop all his information in the description below. But these are the top banks that we currently have, and this is their total assets we're looking at. And we could see, important data that's all around here. Let me just get this. This is everything that's going on right now. So as of June, this data is still correct. We can see, over here we have short-term FHLB loans. We have their loans as equity. And we also have total deposits and deposits over 250K. We can also see number of accounts that have over 250K and percentage of their deposits that are over 250K. 250K. It's important because we need to see the difference between what are considered regional banks, what are considered whale banks, and what are considered pretty much just general standard banks, right? So we could take a look at some of the important data within these. We can see that JP Morgan is clearly, the number one bank. We can see that percentage of deposits over 250K is about 42%. So it's pretty middle of the road, nothing too crazy when we look at JP Morgan, right? We don't see some of these extreme high level of deposits above 250K. So that means that that's, for the most part, they should be FDIC insured for a good amount of accounts. But I want to take a look at some of the ones that have the top, federal home loan banks, where their percentage of that loan is their equity. And if we take a look at this, we can see that the top ones that pop up are Signature Bank, Silicon Valley, First Republic. They're all gone, right? And we can see the percentage of those loans that are considered equity. And for Signature Bank, number one is 140% of FHLB. We could see that Silicon Valley had 97%. We can see First Republic had 77%, almost 78%. So that's absolutely insane. That's a huge amount of percentage of those loans that are equity for these banks. And then it gets even crazier when you look at who's in between. We have Charles Schwab, USAA Federal Savings, KeyBank, and then you got a few down here: PNC, Northern Trust, Truist, Ally. So a lot of them that still have a pretty good amount of these loans as equity. And we can take a look even on this this one. Yeah, you see this chart here that a lot of these are for advances for less than 1 year. So that's not necessarily a great thing. That means that these banks are borrowing from the FHLB, not necessarily, when rates were at 0%. That's when you saw a lot of, JP Morgan and these bigger banks borrowing, because at 0%, it's like, why not? This is pretty much free liquidity that we're being offered. And then we just pay it back whenever we can, right? Now, these banks were borrowing at the worst possible time when interest rates were extremely high, and their loans are good for less than a year. So it means that they didn't have enough funds on hand to pretty much operate. And that's not necessarily a great thing. And I want to take a look at, some of these banks that have extremely high levels of deposits over 250K. I thought this was also an interesting metric that he brought up. And we can see that once again, look, Signature Valley was 94%, Silicon Valley was 89%, and First Republic are 79%. These are the top three banks. And the problem we're talking about right now with the banks that have been failing, these are the banks that failed, right? We keep talking about regional banks, that it's the problems with the regional banks and that people are, the ones that are, common people are the ones with their money who's being lost because these banks were careless. Of the five that have collapsed, those three are the top three, and they're all whale banks, right? These are not banks that you and I tend to be using. These are banks that, Silicon Valley, that's a VC bank. First Republic, we can see that the amount of deposits over 250K here is 80%. It's not, these are people that have tons of money tied up in these banks, and that's not necessarily a great thing to see. So does that mean that the regional banks are fucked? In a way, they can be. I think the fallout of these banks has impacted them even more. But I do think that means that some of these bigger banks, some of these banks that have high percentage of FHLB as equity, high percentage of deposits over 250K, are in a pretty bad place too, right? So, I mean, let's look back at this again. Let's take a look at percentage of is equity. We got Charles Schwab here. We got Charles Schwab here. We're going to highlight that one green. We got USA Federal Savings. Highlight that green. We got KeyBank here. We highlight that one green. And let's throw in some of these too. Let's say Truist, because Truist is really interesting to me. I think that one's, again, if we look at, I didn't know who Truist was prior to this, but you can see that they're also they're the ninth top bank in terms of total assets. And they have a pretty high level of FHLB out there. They're 49% of their is their equity. And they also have a pretty good amount in terms of how many people are using their bank. So it's a top bank that we should be keeping an eye on, right? And if we see all this together, I want to pull up something that's really interesting to me, which is we are seeing the same thing with those top banks. Where's my chart? Here I am. Kind of bleed into some of the news. And we know that Charles Schwab is laying off people and they're saving about $500 million a year. So about $500 million a year. And I understand why. Obviously, they seem like they're in a pretty tight place with the loans that are out there. And as of a week ago, we can see that BMO Harris, Wells Fargo, and USA are the top banks, latest banks to report layoffs. So these banks are definitely hurting, right? There's definitely a place in this market where these banks are trying to cut costs at all corners to the market. We can see that these rates are continuing to impact them. And there's a question of why these banks are hurting. Is it a matter of solvency or is it a matter of liquidity? And I think that the problem is not so much solvency. I think it's liquidity. And I'm going to pull up the last chart here, which is really important. This is all commercial banks deposits, in the history of since, I guess, 1974 to where we currently are. This black line means 0% down here. And this, obviously, the chart where it's going up and down is the percentage from a year prior. And we can see that we're currently inverted. We're at negative 3.7% as of Wednesday, August 16th. So what does that mean? That means that a lot of money is leaving these banks. People are pulling their money out. Are they entering into, the money market? Or are people trying to make money on, treasury bills and stuff like that? Maybe that's the case. But we also know that people aren't necessarily borrowing right now, right? So if people are paying off their loans and these banks can't pretty much issue loans, well, then that money gets deleted from this, from the money supply, right? Because they can't generate or issue any more debt. So if that's the case, then guess what? There's a liquidity crunch because there's not enough money coming into the space. And if money continues to contract like it is right now, and we see that assets are inverted, where assets are extremely high in value, but the money supply is low, that means that money is going to have to come from somewhere. It's likely to come from assets. And again, that's relating to the stock market. But this is pretty much showing you the health of these banks. And these banks are not in good shape right now. So looking at that and everything we've talked about just right now, I honestly believe that we are going to see more bank crises coming in the next few months. I was telling JWeb and Mr. House last night that I sold all my UNG and my USO. And the reason I did that was just to free up some cash. And I honestly just wanted to take advantage of what I think is an opportunity. I bought some puts on a few banks, and I used the data there to pretty much give me a good indication of which banks are the ones that are currently hurting. Is it low risk, high reward? Absolutely. I mean, worst comes worst, I lose 3K or something like that. But then if you're doing something that people aren't expecting, and I don't think based off the prices of some of these options that people were honestly anticipating any of this going through, then I think that there's possibly a good chance that one of these banks, these ones that are seeing extreme financial stress, they're seeing deposits go down, they're not able to generate income, they have to lay people off just to save face. And then we're seeing rates that are probably going to continue to increase. That's why I wanted to do this show today before the PCE data, before September hits, because again, we saw that Lehman Brothers and Washington Mutual both went out in September of 2008, and we just saw a cascading effect. We've only had 5 banks fail this year. We've had a lot that have been extremely stressed in the regional sector, but for the most part, the big banks are the ones that have been going under, and I don't think that it's over. And if we are looking at what the Fed has done with the bank term funding program, they've pretty much bought them time. And if they continue to do that, it just makes this problem even worse. Liquidity is the issue right now. And I think that if we do get to a point where, say, Charles Schwab or, Wells Fargo or one of these other banks that, seem extremely stressed right now, get to a point, Truist, I will even say Truist, because I saw that in 2019, they merged. It was 2 banks that merged together. So these banks have had problems since before the pandemic. if they continue to push forward with this, I think that we're going to see one of the worst contractions in terms of banks. And I think that right now, the Fed, if they decide to intervene, like they did with Silicon Valley, that's the worst possible thing we could see, because that's just going to keep pushing this bear market even longer. So what needs to happen is, if we do start to see some of these banks fail, they kind of have to let it go. They
Yeah,
have to.
I mean, I don't know if we'll ever see them actually let anything go. Is the only
I know.
like we can say what we think they should do, or we can kind of make our moves based on the most likely outcome, right? Because once again, it's a wish in one hand, shit in the other situation, right?
They save them. The problem is that inflation can honestly go up again, because they would have to do quantitative easing. They'd have to lower rates, and that could easily send us into another fucking 1970s where we're staying elevated till, I don't know, 1981, 1982. That's the problem. And that's why I think that whatever comes next, if it is too overboard, where we start seeing a lot of failures, which I honestly think is possible, then there's not much that they can do. I know that they saved. I mean, JP Morgan fucking bought out both Washington Mutual, and they bought out Bear Stearns back in 2008, but they let Lehman Brothers go completely, right? They saved AIG. So they probably will save some people, but at that point, it gets to a point where it's like, okay, this is going to hurt us long term if we just continue to let it go. We have to rip the band-aid off at some point. I don't know if they'll do that in an election year, going into one, but definitely seems that there's a lot of stress that is currently sitting in the laps of, man, I'm getting texts like crazy from Bitcoin's price dropping below 26K. But yeah, I think that there's huge stress coming to the banking sector. That's why I put my bets on banking right now. Again, it's I think people aren't anticipating it, even though I think we all know it's happening. But I think we have a good step up on seeing what has happened in the past, what's happening in this market, where liquidity is being met with some some turbulence. And we can see from that chart that Schwab, Truist, BMO, Wells Fargo, USA, Federal Savings. I'm not saying these banks are all going to go under, but I think that we see that those are the ones that are most stressed, and those are the ones we have to keep an eye on.
All right. Very, very well thought out there, Kev, for sure. That was excellent. So definitely a lot to think about as far as, I mean, if you have exposure to those banks, I don't know, not financial advice, maybe don't.
It's fucking hilarious. He's not wrong, though. It's absolutely insane that it's not great that
yeah, it's not great that one of our most loyal listeners would be drowning right now if he was drinking water and kept saying that stuff. But all right, that is going to be how we wrap it up for today. We'll be back tomorrow discussing the latest jobs numbers, how the market is reacting, whether or not Kevin is still bearish, whether or not Chris Hoddle has drowned from replaying this show. There's a bundle of good news, sunshine and rainbows coming straight out of Kevin's ass over here. Really appreciate everybody for watching again. If you have not yet, down below, like, comment, subscribe, share it out on social, all that good stuff. Exciting week ahead. So much to cover, so much activity in the markets. We're seeing a little bit of movement in crypto right now. Interested how it's going to play out. But I hope you guys have a great rest of the day. Appreciate you. We will see you next time.
Take care, everyone.